Hey everyone, all you future CAs out there. Today, we're diving into an ICAI favorite, a standard that can be a real goldmine for marks if you know how to handle it. AS12, Accounting for Government Grants. So let's jump right in with a question that trips up so many students.
And there it is. This looks so simple, right? But believe me, this is a classic ICI trap where a ton of marks get lost. Is it income? Is it some kind of capital contribution? The answer? Well, it's not always a simple yes or no, and getting it wrong is costly. But don't you worry, stick with me, and by the end of this, you'll have a rock-solid framework to nail this every single time.
Okay, let's put this into a real exam-type problem. Picture this on your paper. Your company's bank account just got a sweet 10 crore grant. Awesome, right? But there's a catch. There's always a catch. You have to employ 500 local people for the next 5 years. So what do? Do you book that entire 10 crore right now? Do you wait? And how in the world does that employment condition change your accounting entries? This is exactly the kind of puzzle we need to solve.
So, where do we find the answers? Well, it's all laid out for us in our go-to guide for this, Accounting Standard 12. Think of AS12 not as some boring theory, but as your practical playbook for handling any kind of government grant the exam can throw at you. So let's break it down, step by step.
All right, let's kick things off with Section 1, the grant trap and the basics. We need a solid foundation before we build up to the complex stuff.
First things first, what even is a government grant? Well, AS12 says it's help from the government. Could be cash, could be something else, like a piece of land. But now listen to the most important part of this definition, for past or future compliance with certain conditions. This is everything. A grant isn't just free money falling from the sky. It's tied to an obligation. You have to do something to earn it. And this idea is the heart of the entire standard. We have to match the grant income with the cost we incur to meet those conditions. So, when the money comes in, how do we think about it? There are basically two philosophies. First, the capital approach. This treats the grant almost like the owners themselves put in the money. It goes straight to shareholders' funds, usually into something called a capital reserve. You'd use this for grants that are really meant to build up the company's financial foundation. But the far more common method is the income approach. Here, you recognize the grant as income in your profit and loss account over time, matching it against the expenses you're spending to meet the grant's conditions. It all comes down to the nature of the grant.
Okay, let's jump into Section 2. This is a big one. It's all about when you get to actually record the grant in your books. If you mess this up, the rest of your answer doesn't matter. These are the two golden rules you just can't afford to forget.
Okay, lean in for this one, because this is where so many students lose marks. You can only recognize a grant if, and I mean only if, you meet both of these conditions. Number one, you need reasonable assurance you'll actually comply with the strings attached. Number two, you need reasonable assurance you're actually going to get the money. ICAI loves to play with this. They might say, the company got the check, but they're not sure if they can meet the tough conditions. In that case, you can't recognize it yet. Just getting the cash isn't enough. Both conditions have to be ticked off.
All right, now for the main event. Section 3, Grants for Fixed Assets. I really can't say this enough. This is the most critical, most frequently tested part of AS12. If you can master this section, you are in a fantastic position to ace any question on this standard.
So, when you get a grant to buy a specific fixed asset, AS12 gives you a choice. There are two methods, and both are perfectly acceptable. Method 1 is super direct. Just subtract the grant from the cost of the asset. Method 2 is a bit different. You treat the grant as deferred income, which is kind of like a liability, and then you slowly release it to your P&L over time. Let's break down each one. Okay, method 1. This one's straightforward. You get the grant, you knock it straight off the asset's value on your balance sheet. So what's the ripple effect of that? Simple. A lower asset value means you'll have a lower depreciation expense hitting your P&L each year. The benefit of the grant is shown indirectly, through a smaller expense over the asset's life. And these journal entries show it perfectly. You buy an asset for 50 lakhs. Debit fixed asset, credit bank. Easy. Now the 10 lakh grant comes in. You just credit the fixed asset account directly. See that? The asset's book value instantly drops from 50 lakhs to 40 lakhs. So now, when you calculate depreciation, you do it on this new lower value of 40 lakhs. Let's say the useful life is 5 years and salvage value is 5 lakhs. The depreciable amount is now 35 lakhs, right? 40 minus 5. And over 5 years, that's an annual depreciation of 7 lakhs. That's the impact on your P&L. Now for method 2, the other way to do it. Here, you don't touch the asset's cost at all.
Instead, when the grant money comes in, you create a new liability account called Deferred Government Grant. Then each year you move a little bit of that deferred income into your P&L, usually in the same proportion as your depreciation. And here's a huge point for your exams. If the grant is for something that doesn't depreciate, like freehold land, it goes straight to capital reserve. Why? Well, you can't match it to an expense if there is no expense. That's a key exception.
Let's look at the entries for Method 2. The 10-lakh grant creates a liability. Now, importantly, your depreciation is calculated on the original 50-lakh cost, which works out to 9 lakhs per year. But then, you also recognize a piece of the grant as income. You take the 10-lakh grant, spread it over 5 years, and that's 2 lakhs credited to your P&L each year. So, check out the final P&L impact. You've got a 9-lakh depreciation expense, but also 2 lakhs of grant income. The net hit to your P&L is 7 lakhs. Wait a second, that's the exact same net impact as Method 1. It's a fantastic way to check your answer in an exam. The destination is the same, it's just a different road to get there.
Okay, we've nailed the big one on fixed assets. Now let's get into the tricky stuff, the special cases and common errors that ICAI just loves to use to see who's really paying attention. What if the government gives you, say, a piece of land instead of cash? The rule here is dead simple, but you gotta remember it. If you got it for a cheap price, you record it at the price you paid, your acquisition cost. If you got it for free, you still have to put it on your books, but at a tiny nominal value, like 1 rupee. Now what about the market value? It's completely irrelevant. For accounting, just ignore it. Please remember this one.
Just look at this slide. The government gives you land that's worth 20 crores, but you only had to pay 50 lakhs. What value goes in your books? The 50 lakhs. That's it. You have to pretend that 20 crore number doesn't even exist. This is such a common trap in the exam hall. Don't be the person who falls for it. Record at acquisition cost. Period.
And that leads us right into an exam alert. Let's look at some classic mistakes that students make based on a typical illustration. This is important. Here are 2 absolute classic errors. First, a company gets a grant to build a factory, but then uses some of that money to pay dividends. Nope, you can't do that. A grant for a factory has to be used for the factory. It's not just free cash you can give away to shareholders. Second mistake, a company gets land for free and just doesn't record it, thinking, well, we didn't spend any money. Wrong again. As we just saw, AS 12 says you must bring that asset onto your books at a nominal value.
Okay, what about grants for day-to-day stuff, not big assets? Like maybe a grant to help you pay salaries. We call these grants related to revenue. And the accounting here is way simpler. You've got 2 options, and both are totally fine. You can either show the grant as other income in your P&L, or you can just subtract it directly from the expense it relates to. So you could either boost your income or just show a lower salary expense. Your choice.
We're in the home stretch now. Let's wrap up with the last bits. What happens if you have to refund a grant? And what do you have to disclose? Don't skip this part. These are the details that get you from a good score to a great one. So what if you break a condition and have to give the money back? Well, the accounting is basically like hitting the undo button on your original entry. For instance, if you used Method 1 and deducted the grant from an asset, you'd now have to add that amount back to the asset's value. It's a change in estimate. And finally, disclosures. You have to tell people 2 things in your financial statements. What's your accounting policy? Did you use Method 1 or 2? And second, what's the nature and amount of the grants you've recognized? These are non-negotiable.
And that is AS 12 from top to bottom. But before you go, I've got a little puzzle for you to really test your understanding. Let's say you get a grant for land, a non-depreciable asset, but this grant has conditions that you have to meet over the next 10 years. Now, what do? We learned that grants for non-depreciable assets usually go to capital reserve. But here, you have costs and obligations over a specific period. So should it still go to capital reserve, or should you maybe credit it to income over those 10 years? Ponder that one. The answer lies in the matching principle, the core idea we started with. Thanks for tuning in, and all the very best for your exams.